This conference will now be recorded.
Okay, Marissa, whenever you're ready.
Okay, good morning, everybody, from very, very frigidly cold Kinderhook. Thank you for joining. Today, I am going to be talking about socially responsible investing, and hopefully people have brought questions, and I'll type them in the box, and at the end, we'll do question and answer. If you have any more questions, and we'll stop the recorder so everyone's faces can be shown, and we can all talk and be a little more conversational at the end. So the first part is going to be really just an overview of what is socially responsible investing and what it might mean for you. And then again, hopefully you'll bring a lot of questions for the end. If you have anything along the way, go ahead and put it in the chat box and I'll follow along with that. So to get started, socially responsible investing is the term that I kind of use, but it doesn't necessarily mean that's the term, and it might be that you've heard other terms for it. There's some of the names are impact investing, ESG, which stands for environmental, social, and governance. There's values-based investing. There's sustainable, SRI, which stands for socially responsible investing. They're all different names that mean slightly different things. Often they're used interchangeably, whether or not they are exactly interchangeable. But if you're out reading or someone's mentioning about this kind of investing, these are the keywords where you can kind of have an idea of what they're talking about. So again, for the sake of this presentation, I'm probably going to just use socially responsible investing or impact investing, but with the idea being that kind of covers all these different topics. But most basically, what is socially responsible investing? So socially responsible investing is looking for positive long-term economic, social, and environmental returns, as well as your financial gains. So it's not to be confused with just making a donation to a charity where your sole focus is doing something good in the world or supporting the growth of the charity. You are still investing for your own financial growth. But what you're doing is not only looking for the financial growth in isolation of which companies are the best, which will have the biggest earnings or profit next quarter. You're also trying to consider the social, environmental, perhaps diversity considerations of the company and how that will impact, yes, your returns, but also the globe in a greater capacity. So there's different things to consider. There's some of the most common things that I will consider and that people are interested in is investing in climate change solutions or divesting from weapons manufacturers or trying to divest from companies that have a bad human rights record. But sustainable investing can be very forward thinking. It's not just, oh, how have companies done in the past, but it can be looking at companies that are trying to do better going forward. Or, for some people, it could be an oil company isn't necessarily bad if it's the oil company that's trying to have fewer floods and to do more climate change work in the future, that are trying to move to cleaner energy. So it doesn't necessarily need to be that there's no one kind of company just because in the past that company, in your opinion, didn't do the right things, but it could be trying to put your money towards the companies that are moving in what, based on your priorities, is the right direction. So I just mentioned a few of them, but some of the relevant issues that a lot of socially responsible investing looks to prioritize or to steer clear from are governance issues. So looking at the head of a big company and saying, okay, is executive pay wildly out of touch with what the standard worker is getting paid? What kind of political donations are they making? Are those donations going to things that you think are right or that you don't really want to support? Social, which is human rights, how are people paid? Is there a lot of employee turnover, which is usually a sign that people aren't being treated as well as you might otherwise expect? Do they use a topic that's gotten a lot of, been in the news a lot lately, is you can talk about what's going on in China And do you want to be supporting companies with your investment dollars that are manufacturing their products from what could be slave type labor? What kinds of priority, again, it comes back to what kind of priorities you have and where you want your dollars to be invested and help grow. The final one, I know I went in reverse cycle here, but the final one is environmental. I would say that's the one that most often people think of when they think of socially responsible investing, or will first come to me about. And that's wanting to invest in companies that, again, are thinking forward, are clean energy, or are at least trying to clean up their own act, or invest in things that, electric vehicles or clean water, looking for companies that really are trying to move towards preserving the earth. So this, in the very beginning, that beautiful tree that I showed is all the different names for socially responsible investing. So along with that, there really are, if you want to get down into the nitty-gritty of it, there are a million ways of actually investing in socially responsible. What it means to you is absolutely going to mean something different to the person sitting next to you. This is sort of a chart of the different flavors of ESG investing. It can start with, if we start at the bottom where it says impact investing, well, there you're really talking about trying to make a real impact with what your money is doing. So that's investing in, let's say, wind turbines. Like, you are investing in companies that are proactively doing something to deal with an issue you care about, whether it's clean water or energy or anything else like that. Then you can move up the rung and you can talk about exclusionary, which is really where socially responsible investing got its start, which is it started as no sin stocks. So people started saying, we don't want to own guns, we don't want to own tobacco. So it became, you can own everything else in the entire market, but you just won't own any of those, what were called sin stocks. So that's sort of the old-fashioned approach. It's what a lot of people still think of as socially responsible. And there are many funds and advisors who will just steer clear of those types of stocks, or the one you hear the most of is not owning any firearms. As we go up this chart a little bit more, it becomes a little less, it's less about just exclusion and more about using different tools of social responsibility and analysis to actually kind of improve your investments in certain ways. So it's looking at the top, ESG integration, which is actually not just excluding, let's call them the sin stocks for now, but although most ESG funds will say no firearms, but beyond that, it's trying to actually look at companies for what's best in class. So if your number one priority is still, we want to have good growth for our clients, then what we're going to do is say, okay, we want our clients to have, let's say, 10% of their portfolio should be in large US companies, large companies based in the United States. That's what we want them to have exposure. Okay, so we come up with a list of here, let's say these are two companies that are both US large companies that both seem to have positive earnings and seem to be led pretty well, and they seem, we expect them to have similar growth prospects. How do we pick between the two companies? If you aren't using an ESG screen at all, you're only going to be looking at what is the bottom line. What is the performance in the past? What's the performance in the future? Who's actually going to just grow the most in the short term, long term, medium term? Once you bring in the ESG integration, what you're going to actually start saying is, okay, we've got two good companies. Which one has more diversity? And that's good because you maybe prioritize having diversity, but it also could be good because a lot of research shows that having diversity in a board leads to better results in the long term. Now you're also going to say, which company has fewer governance issues? So which company gets called into Washington, D.C. less because they have compliance issues? Once again, that might be because it aligns with your priorities, but it also, and we'll get in the next slide, we'll talk about it, but it also means the company has less legal issues and probably is spending a lot less money paying off governments for getting into trouble. The last piece of that is climate change. And if we're looking at ESG integration, companies that are looking towards the future and cleaning up their environmental act before, let's say, a government says they have to, well, they're going to be steps ahead when the government does say they have to. So once again, it's not just saying, no, we won't buy any companies that are in the energy business, or we won't buy any companies that pollute. It's ESG integration is more using the value that we learned from by prioritizing socially responsible or ESG factors and how that can improve your investments, and integrating that again with the end goal being to grow your own assets, but to do it in a way that mitigates harms to the earth. So what I mentioned in the last one was about how ESG integration can actually impact returns. And here are a couple of examples where you could see if you were paying attention to the ESG factors before these things happened, you probably would have gotten out of the companies to begin with. I imagine all of you will remember all of these. In 2010, BP had a massive oil spill, and if you were just considering ESG integration leading up to that, you probably wouldn't have held much BP. The energy company has not been, the oil company has not been great towards if you screen for ESG, but in particular back in 2010, they weren't even moving towards trying to be greener. Well, they had a big oil spill, and it ended up costing almost $54 billion in cost to them. Not even including reputational damage and what actually happened to the earth. Here we're just isolating, okay, it was bad for the earth, bad for all the people who lived there, but also if you are just looking at it as an investor, it was really, really bad for you as an investor. Next, we can take Volkswagen in 2015, where if you were screening for ESG factors, you would have noticed that Volkswagen was starting to drop on the governance side. It was starting to not rate as well. And then you find out that they've been rigging their emissions tests, and there we go, 27.4 billion euros in penalties and fines. Again, not even talking about the massive damage it did to the environment because they were cheating emission scans and emissions tests and reputational damage to the company. We're just talking about bottom line. So again, looking at how considering an ESG factor not only could improve the earth and what you're actually putting your money towards, but it's actually could have a direct relationship to the returns in the company you're investing in. 2018, if you remember, Facebook had similar issues around governance, and Facebook has spent a lot of time now defending itself in DC. Similar thing. Again, it's not just about the world's impact, but if you're looking at the earnings, direct relationship between the ESG considerations and what happens to the company. So another thing about ESG investing, what I personally appreciate about ESG investing and why I incorporate at least some ESG investing, even for clients who, for them, it's not a priority or they think it's some sort of, investor voodoo. It's just that there's actually a ton of momentum going towards ESG investing right now. So even if you don't buy any of the stuff that I just explained about why ESG investing could be beneficial, you're still talking about, you could still be riding this wave of a lot more money, especially younger investors are asking these questions about their investments. They're asking, is there any diversity on the board? Is there any slave labor being put into the manufacturing process? Are we protecting the earth through what you're manufacturing? A lot more people are asking that. So even if you don't necessarily care about those things. The fact that other people do, and the stock market is a herd mentality type of thing, there can be a lot of benefit for you to have your money already placed where in companies that rate better on ESG, because the tide is going much towards those companies. So again, I think it's even if, and a thing to share clearly, anyone who's here today probably already leans towards finding value in socially responsible investing. But for people who aren't on the bandwagon, just as an investment perspective alone, again, completely away from how you actually feel about the earth or the priorities embedded in ESG investing, I think it's very wise to incorporate some ESG strategies in really any portfolio. And this chart is just showing you the growth of ESG over the last, since 2006. So I'm going to bring you back now to the friend who you might be talking to who is a non-believer in the value of ESG investing, and actually sort of start on the misconceptions that I hear a lot when people talk about ESG investing. Some of these I've already touched on, but I'll go a little more in depth. But the first one is that ESG investing or socially responsible investing necessarily excludes entire sectors. So that again comes from the founding principle of when ESG investing was first created, which it really was to keep sin stocks out of people's portfolios. That's progressed a huge amount, and now you can find any flavor of ESG investing. And so this is just showing you the different kinds of where people have their money when they go to ESG investing. So in the United States, you can see some of it is screens. So that's really, the yellow is screens, which is where it's saying exclusionary, no guns, no tobacco, or whatever other screen you want. But that's really just a small piece of it, of the pie right now. It's also some impact investing, which is really that target investing, where what we talked about, where you really just, you only want to be investing in clean energy. That's where you want your money. Again, that's a small part. The biggest piece is more of integration and some thematic. And that's what I was talking about before, where you're not excluding entire swaths of companies, but what you're trying to do is look at earnings and projected returns and imbuing that with your ESG considerations. So also looking at who's running the company, do they get in trouble? Are they trying to have a better impact on the environment? So really more of a best-in-class approach as opposed to an exclusionary one. The second one is that ESG, socially responsible investing, involves using a specific investment strategy or product. Again, it doesn't, socially responsible investing doesn't necessarily require any specific strategy or product. It simply involves including your ESG screens or your ESG information in the decision-making process. So you can go anywhere on this chart. You can go from traditional investing, which is really over on the left-hand side of your screen. So you're only looking at the finance, all the way over to impact only, where you're really only using your money to promote specific causes that you care about. Impact investments, I would just say, it can be as straightforward as banking with a community-based financial institution. So all of these, it doesn't necessarily need to be where you're putting every last investment dollar, but it could be who are you actually investing with? When you hire your financial advisors, is there any diversity in the firm? When you go into a bank, are they community oriented? Who owns the bank? Is there diversity there? So it can be, you can use ESG integration in every aspect of your life. It's a question of what is your money using, what is your money doing? So if you think about if you walk into a store and you see two products and you're the kind of person who looks and says, oh, was it made in India, or where, was it made in the USA? Was it made in China? What is it made of? Is this something that's going to end up in the landfill? A lot of people think like that, but then when they go and invest their money, the big dollars, not just the $3.99, let's say Christmas ornament, they forget all about that consideration. if you're the kind of person who cares about what is going to end up in the landfill, and you care about where your products were manufactured and who manufactured them, it makes a lot of sense to me for you also to be considering what your investment dollars are doing. And it's the same thing, it's just multiplied the effect. So the next big one, I would say this is almost like the elephant in every room about socially responsible investing, is that ESG investing leads to lower returns. The research shows that's not true. And anyone who wants this chart for whenever anyone wants to show it to someone, I'm happy to share it with you. I found it on Charles Schwab. It's not socially responsible investing. The studies have not shown that they have some huge, outsized, incredible extra growth compared to not doing socially responsible investing. What it shows is it's pretty much the same. That's what this chart here shows you. The ESG funds are this dark navy. The light one is all international. This is US without screening for ESG. And you sort of follow the chart through, and you can see that the ESG and non-ESG is they're pretty close. They cross lines here and there, but they're pretty close. So what that says is that ESG investing, from a return standpoint, it's where we are right now. It might not be, it might not add a lot of return, but it's not detracting from it. So if a concern to you is what is your money doing in the world, you should feel pretty comfortable being able to put together a portfolio that has ESG integration without worrying that it's going to be detracting from your returns. Now, even more important than that, and another reason why I like to use ESG considerations, even for those clients who are not all that interested, don't prioritize those things, is that while the returns are pretty much the same, the research has shown that ESG considerations actually reduce the risk or the volatility of the market, of the investments. And that kind of makes sense if you think about that earlier slide with all the different companies who, had big environmental issues or governance issues and then ended up spending a whole lot of money in legal and compliance. If you're investing in companies that have a diverse workforce, have a diverse board, they're getting a diversity of opinion. So there's a lot of likelihood that they're going to be seeing problems a lot quicker than a company that's run by people who all look like each other and agree with each other. If you have companies that are proactively planning for climate change, they're going to be much more prepared for when problems start to arise. So they're able to handle volatility in the markets a bit better. And that's what the research shows, is that the standard deviation, which is the measure of risk in a fund or an investment, is less with an ESG fund than with a comparable non-ESG fund. So you might be getting the same returns, but whereas the non-ESG is more bouncy, the ESG considerations can make it a steadier ride. Yeah. So how do you actually invest in socially responsible investing is a big question, and the answer is pretty simple, exactly how you invest in everything else. Back when this type of investing started, it was, there were only a few funds who would do these exclusionary funds, or you would do microfinance, but the world of socially responsible investing has opened up very, very broadly. So I'm going to just do a quick overview of the different vehicles for investing. For all of them, you can find socially responsible or ESG screened approaches. First, there's venture capital, and that's where you need to be an accredited investor, and then you're able to actually put your money towards new companies that are just starting up. There are venture capital umbrella investments where you can get in at the ground floor for different companies that are either promoting people of color, or they're promoting female-run venture capital, which is a big issue, is very, very few venture capital dollars go to those communities. So that's a place to actually more directly put your money if that's something you're interested in. And then there's individual stocks, which we all know individual companies, but you can think of, you know, you can go and buy Tesla if that's a company that you think is electric vehicles and you care about that. Or if you think, if you're very impressed by Apple and you think that they're doing good for the world, you can go and buy their individual stock holdings. There's tons of research available online, and Morningstar is starting to give more information about social responsible metrics, so you can put in all your companies and read about, you know, see who's running the company. Is there any diversity? See what kinds of citations they might have had in the past. The next approach is we started the tiny company, and we're going to start broadening up, is exchange traded funds. And ETFs consist of a mix of different assets. So it's a bunch of different individual companies, but they now have ETFs, or again, it's called exchange traded funds, that have different screens for different socially responsibility metrics. So there's one that prioritizes companies that at least have 1 or 2 female executives. There's ones that are focused on clean energy. They run the gamut. Then there are ETFs that just are exclusionary, saying no guns, no tobacco. Finally, mutual funds, which is the more old-fashioned type of holding a bunch of assets, a bunch of individual stocks. Very similar to exchange-traded funds, but it's usually a little bit more actively managed by an investment advisor inside of the fund. Within the socially responsible realm, it's the trickier to access asset classes. So more like the small companies or international or developing markets. It can be easier to get socially responsible access through mutual funds because there's more on the ground work than with an exchange traded fund, where it's more of a computer algorithm is setting the restraints on what different companies are going to be included. So with a mutual fund, you tend to have more of an active investment advisor picking the companies that are going to be inside of the fund. So if you're prioritizing ESG investing, you want to know more about the companies probably. You're not just happy with a computer saying, these are all the companies that are in the S&P 500, therefore they are good. You probably want to say, okay, here are all the companies in the S&P 500, which companies are prioritizing the things that you hold dear. And to do that, a lot of mutual funds can usually provide an easier entry point for people who are concerned about socially responsible investing. So that is my overview to socially responsible investing. And I'm going to see if there's any questions here, and then let's turn off the recorder so that we can let everyone come on, and so I'm not so lonely here.